Now, as we move into mid-March, markets often begin to trade differently, not because of a new macro shock, not because of an earnings headline, but because of something quieter and mechanical. That is quarter end rebalancing. Every March, large institutional investors will adjust their portfolios back towards their target allocations. This is widely covered in financial media each quarter, especially when equities and bonds have diverged meaningfully. And today I want to walk that through with you, how it works and which markets tend to reflect it most clearly. So let's start with the most important relationship, and that is the S&P 500 versus the US 10-year Treasury bond market. Now, many pension funds and institutional portfolios operate with fixed allocation models. Often it's some variation of 60% allocated to equities and 40% allocated to bonds. Now, if the S&P 500 has significantly outperformed Treasuries during the first quarter, these portfolios become overweight equities, right? And so what happens to rebalance that, managers will sell equities and buy bonds. So if bonds, however, are outperforming in the first quarter, the reverse can happen. So Reuters, Bloomberg, they often report this dynamic near quarter end, especially after strong cross asset moves. So the first thing to examine in March is this: how has the S&P 500 performed relative to the US 10-year Treasury so far this quarter? And it's that divergence that often shapes the tone of late March flows. So for instance, if the first quarter has been very strong for equities, sometimes you can see late March, you might see some modest equity selling pressure as allocations are normalized. But if bonds have led, then you might see equities have more supportive flows as more asset allocations move into equity markets. So the key point here, right, these flows around the first quarter, they're not about earnings, they're not about economic data, they're about allocation discipline. And because they're rules based, that makes them seasonally relevant. So the seasonal takeaway isn't that March is bullish or bearish, right? It's that late March is often influenced by the relative performance between equities and bonds. And the bigger the first quarter divergence, the more relevant rebalancing flows can become. And that's what asset allocation reveals. So, you can have a look at the first quarter, how has the S&P 500 performed, and then you can use that as a proxy for late March, early April equity market demand. Now, March is also unique for another reason, because we have Japan's fiscal year end on March 31st. Again, this is frequently covered in financial media, particularly in the context of the dollar yen. Now, Japanese institutional investors, including pension funds and insurers, will often adjust their overseas asset exposure and currency hedges before that 31st of March fiscal year end deadline. So as a result, the yen and the dollar yen can experience increased volatility into late March. And you can see that there's some pretty interesting seasonal patterns. You can see at the from just like the 31st of March into the 13th of April, you can see this bias for yen strength that then gets reversed mid-April. And you can see there's a bias for yen weakness. It's also worth watching the Nikkei 225 as domestic equity allocations also shift during this period. And you can see here from mid-March into the end of April, tends to be a very strong period for the Nikkei. And if you look at from mid-March, just before the year end, you can see there's a 75% winning trade percentage with a 2.57% average return. Again, these asset allocations don't guarantee direction, but they can create temporary distortions. And you can look at the historical volatility of these periods using Seasonax. Another useful instrument to monitor into quarter end is the VIX index, or the fear index. Financial media often describe late quarter markets as positioning driven, right? So you might see volatility compression or short-lived volatility spikes, particularly around that sort of final week of March. And that tends to reflect adjustments, not necessarily any new macro developments. So practically, you can see here on the first day of the second quarter that the VIX tends to spike higher on those 2 days. You see there's an average bias to the upside, 60% winning trade percentage. And if we look particularly over the last sort of just 15 years or so, you can see that there is that bias for volatility to spike quite significantly higher around the first day of the second quarter. So practically, here's what Seasonax allows you to examine. The relative performance of the S&P 500 versus US 10-year Treasuries, how equities behave in the final 10 trading days of March. You can take a look here and see the S&P 500, final 10 trading days in March, 70% winning trade percentage over the last 10 years, 1.36% average return. You can look at the dollar yen around the fiscal year end for Japan, the Nikkei 225, and you can look at the late March pattern here, that bias for upside. VIX positioning around quarter end. Remember, you're not looking for perfection here. You're looking for recurring tendencies in a flow-driven environment. So quarter end rebalancing is a widely documented institutional behavior. It's mechanically grounded. It's cross-asset in nature. It's not a guaranteed directional trade, a substitute for macro analysis, or a standalone seasonal signal. It is context, and you can use Seasonax to see the historical volatility over this period. And in these markets, the context does matter, particularly around second quarter rebalancing, because it will vary from year to year. So as we approach the end of March, understanding that relationship between the S&P 500, US Treasuries, dollar yen, the Nikkei, and volatility can all help explain why markets sometimes feel flow-driven rather than fundamentally driven. And seasonality isn't about prediction, it's about recognizing recurring structural behavior. And quarter-end rebalancing is one of those clear structural patterns that happen time and time again in global markets.